Florida's sunny beaches hide a storm brewing in its condo market. A storm that could collapse the entire housing sector. What if I told you the next major financial meltdown isn't starting in Wall Street, but in a luxury high-rise in Miami? This isn't just about Florida. It's a ticking time bomb that could send shockwaves nationwide, and I'm about to show you exactly why your own home value could be at risk. Everyone's talking about a housing crash, but what if the true epicenter is a place no one is watching closely enough? Forget interest rates for a moment. We're uncovering a hidden crisis within Florida's condo market. A perfect storm of soaring insurance, surprise assessments, and overleveraged investors. This isn't just a local problem. It's a domino waiting to fall, threatening to drag the entire housing market down with it. Could a condo in Miami be the trigger for the next housing crisis that impacts your investments? The warning signs are flashing bright red: skyrocketing insurance premiums, unexpected multi-million-dollar fees, and investors playing a dangerous game. In this deep dive, we're exposing the specific mechanisms unfolding in Florida's condo market right now that could lead to widespread defaults and foreclosures, creating a ripple effect you won't believe. Hit subscribe to Housing Intel and ring the bell so you never miss market intelligence like this. The forgotten shadow of Surfside. How stricter regulations are creating unforeseen financial burdens. June 24th, 2021. That's the date that changed everything for Florida condo owners. When the Champlain Towers South collapsed in Surfside, killing 98 people, it sent shockwaves far beyond that tragic sight. The immediate aftermath wasn't just grief and investigation, it was the beginning of a regulatory tsunami that's now crushing condo owners across the entire state. In the wake of Surfside, Florida lawmakers passed sweeping legislation mandating comprehensive structural inspections for buildings 30 years or older near coastal areas and 40 years or older elsewhere. But here's what nobody anticipated. These inspections are revealing decades of deferred maintenance, hidden structural problems, and repair costs so astronomical they're forcing owners into financial ruin. Buildings that looked fine on the surface are now flagged for foundation issues, corroding rebar, failing waterproofing, and electrical systems on the brink of catastrophic failure. The repair bills aren't thousands of dollars. They're millions. In some South Florida buildings, special assessments have hit $15 million to $20 million per building. When you divide that across a 200-unit tower, you're looking at $75,000 to $100,000 per unit in sudden mandatory fees. According to NBC News reports, homeowners are facing assessments ranging from $15,000 to $40,000 per unit, with some extreme cases exceeding $100,000. Many simply don't have the cash. They can't get loans because their condos have been red flagged as structurally deficient. Banks won't touch them. And they can't sell because buyers won't purchase units with pending massive assessments. They're trapped. Equity is evaporating. Life savings are being drained. The Surfside shadow isn't just a memory. It's a crushing weight on Florida's entire condo ecosystem. Insurance Armageddon. Explaining the astronomical surge in premiums and dwindling coverage options. If special assessments are the knife, insurance costs are the slow bleed killing Florida condo owners. The insurance crisis in Florida has reached catastrophic proportions in 2025. Let's talk numbers. In 2022, the average condo insurance premium in Florida was around $1,200 annually. By 2025, that figure has exploded to over $2,500 for many Miami area condos. And in high-risk coastal zones, premiums are hitting $4,000 to $6,000 per year. That's a 100% to 400% increase in just 3 years. But it's not just about cost. It's about availability. Major carriers like Farmers Insurance and ADAA have pulled out of Florida entirely, leaving condo owners scrambling for coverage through high-risk state-backed pools like Citizens Property Insurance, which itself is underfunded and teetering. Why the explosion? Three forces are colliding. First, climate risk. Hurricanes have cost insurers tens of billions in claims. Actuaries are recalculating risk models, and the new math is brutal. Second, the Surfside effect. Insurers now know structural failure is real, documented catastrophe. That means higher premiums to cover potential liability, and in many cases, outright refusal to insure older buildings. Third, reinsurance costs. The companies that insure insurance companies have jacked up their rates, passing costs down to homeowners. The result? Condo owners face a double squeeze. Mortgage payments already stretched by interest rates hovering above 7%. Now add insurance costs that can range from $300 to $500 per month. For a typical Miami condo owner, total monthly housing costs have surged from $2,500 to over $4,000 in just 2 years. That's pricing out middle-class families entirely. Investors who bought condos expecting steady rental income are watching cash flow evaporate as insurance premiums devour profits. This insurance crisis isn't temporary. It's structural, driven by climate change and actuarial reality. If you're finding this breakdown crucial, tap that subscribe button to Housing Intel for real-time insights that could save your financial future. The Special Assessment Shockwave. Why these unexpected costs are pushing owners to the brink. Special assessments are the silent killers of Florida condo ownership. Unlike regular HOA fees, which owners budget for monthly, special assessments are one-time emergency charges levied by condo associations to cover major repairs or regulatory compliance. And in 2025, they're hitting like financial tsunamis. Here's how it works. A condo board orders mandatory structural inspection as required by post-Surfside law. The engineer's report comes back with problems: failing concrete, corroded rebar, outdated fire systems, balconies on the verge of collapse. The board gets repair bids: $5 million, $10 million, $20 million. Reserve funds don't cover it. Most Florida condo associations have been chronically underfunded for decades. So the board levies a special assessment, dividing total cost across all unit owners. Suddenly, every owner receives a letter. You owe $35,000 within 90 days. For wealthy investors, it's painful but manageable. For working families, teachers, nurses, people who stretched to afford their condo, it's catastrophic. They don't have $35,000 lying around. They try to get a home equity loan, but banks say no because the building is flagged for structural issues. They try to sell, but buyers won't touch a unit with massive pending assessment. They're stuck. Some owners simply stop paying, triggering foreclosure proceedings. Others drain retirement accounts, incurring penalties and taxes. The human toll is devastating. Retirees who thought they'd bought their forever home now face eviction from properties they own outright. According to market reports, buildings across South Florida are levying assessments ranging from $15,000 to over $100,000 per unit. This isn't isolated, it's systemic. As more buildings hit inspection thresholds, the wave of special assessments will only grow, and each assessment triggers a cascade. Owners default, units go into foreclosure, banks dump inventory on the market, property values crater across the board. The Airbnb effect and investor overleverage, how speculation created a house of cards. Florida's condo market wasn't always this fragile, but between 2019 and 2022, speculative investors turned it into a casino. During the pandemic, remote work exploded. Interest rates were near zero, and investors saw Florida as a gold mine. They bought up condos in bulk, often sight unseen, betting rental income would cover mortgages and generate profit. Prices soared. Between 2020 and 2022, median condo prices in Miami jumped from $320,000 to over $500,000, a 56% increase. But the gold rush was built on sand. Many condo associations cracked down on short-term rentals, imposing restrictions or outright bans. Investors who bought specifically for Airbnb income suddenly found themselves unable to rent short-term, cutting projected revenue by 50 to 70%. The market became saturated. By 2023, Miami had over 15,000 active Airbnb listings competing for tourists. Occupancy rates plummeted. Nightly rates dropped. Cash cows became break-even propositions, or worse, monthly losses. Then interest rates spiked. Investors who bought with cheap money at 3% suddenly faced refinancing at 7% or higher. Monthly mortgage payments doubled. Cash flow turned negative. The math no longer worked. A $300,000 mortgage at 3% has a monthly payment of about $1,260. The same mortgage at 7%? Over $1,990. That's nearly 60% increase in monthly carrying costs. Rental rates didn't rise anywhere near fast enough. In Miami, average condo rents rose from about $2,200 in 2022 to $2,600 in 2025, a modest 18% increase. But mortgage payments jumped 60%, insurance doubled, and HOA fees climbed 20 to 30%. The cash flow equation flipped from positive to deeply negative. Investors who were netting $300 to $500 monthly profit are now losing $500 to $1,000 per month. Many are walking away, letting properties go into foreclosure rather than continue bleeding cash. And here's the leverage problem. Many speculative investors put down just 10 to 20%, financing the rest. On a $400,000 condo, that's $40,000 to $80,000 down, with a mortgage of $320,000 to $360,000. When prices fall, leverage amplifies losses catastrophically. If that $400,000 condo drops to $350,000, the investor has lost their entire down payment and is now underwater. Many of these investors own multiple units. One investor, defaulting on 5 condos, dumps 5 units into foreclosure simultaneously, flooding the market and dragging down comps for everyone else. Want to avoid the crash? Subscribe to Housing Intel and stay ahead of the market with data-driven intelligence you can trust. The eviction deluge and banking crisis, how defaults could trigger systemic collapse. The foreclosure deluge is coming. As of late 2025, foreclosure filings in Florida are already up over 40% compared to 2023, according to Property Onion analysis. But that's just the beginning. Condo owners and investors who can't afford insurance premiums, special assessments, and rising HOA fees are stopping payments. Banks send notices. Owners try to negotiate, but there's no equity left. Properties are underwater, and banks have no incentive to modify loans on depreciating assets. Foreclosure proceedings begin. In Florida, foreclosures can take 12 to 18 months to complete, so there's a lag between default and eviction. But the pipeline is filling fast. Estimates suggest that over the next 2 years, tens of thousands of Florida condo units could enter foreclosure. When those units hit the market as bank-owned properties, they'll be priced to sell fast, often at 20 to 30% below market value. That flood of distressed inventory will crater property values across entire neighborhoods. Comps will plummet. Appraisals will drop. Owners who aren't in distress will suddenly find themselves underwater simply because their neighbor's foreclosed unit sold for 70 cents on the dollar. Regional and community banks are on the front lines of this crisis. Unlike 2008's subprime crisis, which was spread across the financial system, Florida's condo crisis is concentrated in regional lenders who wrote mortgages on these properties. Banks like Centennial Bank, Seacoast Bank, and smaller Florida-based lenders have significant exposure to condo loans. When those loans default en masse, these banks will face liquidity crunch. They'll repossess properties but won't be able to sell them quickly at prices that recover loan principal. Losses will mount. Capital ratios will deteriorate. Some banks will need bailouts. Others will fail outright. Regional bank failures create panic in credit markets. Investors start questioning the health of other banks with real estate exposure. Credit tightens. Lending standards become draconian. Suddenly, it's not just Florida condos that are hard to finance. It's all real estate. Commercial properties, single-family homes in other states, development projects. The credit freeze spreads. Real estate markets across the country seize up. This is how a Florida condo crisis becomes a national housing crisis. The ripple beyond Florida. Contagion pathways threatening national markets. Florida's condo crisis won't stay in Florida. Here's why. First, investor contagion. Many investors who bought Florida condos also own properties in Phoenix, Las Vegas, Nashville, Austin, Charlotte. When they default in Florida, they lose access to credit everywhere. They're forced to liquidate holdings in other markets to cover losses. That selling pressure depresses prices in those markets, triggering the same downward spiral. Second, financial interconnection. Banks that lend in Florida also lend in Georgia, the Carolinas, Texas, and beyond. When Florida loans go bad, those banks pull back lending everywhere they operate. Credit tightens across the Southeast and Sun Belt. Third, psychological contagion. When headlines scream about Florida's condo collapse, buyers in other markets get spooked. They start questioning whether their own condo, their own city, could be next. Fear spreads. Demand craters. Sellers panic and cut prices. Market sentiment shifts from optimism to pessimism, and that shift becomes self-fulfilling. Fourth, the snowbird effect. Florida condos are disproportionately owned by retirees and seasonal residents from the Northeast and Midwest. When those owners take massive financial losses in Florida, they cut spending back home. That spending pullback ripples through regional economies, depressing demand for housing, retail, and services. The interconnections are everywhere. Florida's crisis is a node in a vast, complex network of financial relationships and economic linkages. When that node fails, shockwaves propagate through the entire system. Markets that seem unrelated could see price corrections triggered not by local factors, but by contagion from Florida's collapse. The human toll, retirees trapped and communities devastated. Let's talk about the human cost. The most heartbreaking victims are retirees who thought they'd secured their golden years. Picture this. You're 72 years old. You worked your entire life, saved diligently, bought a modest condo in Fort Lauderdale 15 years ago for $200,000. You paid off the mortgage. No debt. Your retirement income is fixed. Social Security of about $2,000 monthly, plus another $1,000 from a small pension. Total, $3,000 monthly. Life is manageable. Then the letters arrive. Your insurance premium jumps from $1,200 annually to $3,600. That's $200 extra monthly. Then a special assessment, $35,000 due in 90 days. You don't have $35,000 in cash. You try to get a loan, but you have no income to qualify. You try to sell, but buyers won't touch your building. You're trapped. The condo association starts foreclosure proceedings. You're about to lose the home you own outright. This is happening to thousands of Florida retirees right now. People who did everything right are being evicted from properties they own because of financial shocks they never anticipated. The psychological toll is crushing. Depression, anxiety, feelings of failure. These are people in their 70s and 80s, too old to rebuild, watching their life's work evaporate. The condo crisis doesn't just hurt owners, it crushes entire local economies. When property values crater and thousands of residents are forced out, small businesses that depend on local residents face vanishing customer base. Restaurants, shops, salons, gyms are suddenly empty. Revenues collapse. Businesses lay off workers, some close permanently. Local tax revenues also collapse. Property tax assessments drop as values crater. Municipal budgets face shortfalls. Cities cut services, lay off teachers, firefighters, police. Quality of life deteriorates, making the area even less attractive to potential buyers. Policy failures and lessons from history. Florida lawmakers have introduced measures aimed at addressing the condo crisis, but critics argue they're too little, too late. One major effort is requiring condo associations to fully fund reserves for future repairs. But for associations already broke, mandating full funding doesn't create money. It just forces them to raise HOA fees even higher, further crushing owners. In some buildings, HOA fees have doubled or tripled to meet new reserve requirements, pushing even more owners into default. Another proposal is creating state-backed loan programs to help owners finance special assessments. But loans require income to qualify, and many retirees don't have sufficient income. Taking on debt in your 70s or 80s is crushing. Some have proposed bailouts, but with tens of thousands of units potentially needing help, the cost could run into billions. State budgets are already strained. Federal intervention seems unlikely without full-blown national crisis. The parallels to 2008 are haunting. In the run-up to that crisis, easy credit fueled speculative buying, prices soared beyond fundamentals, investors overleveraged, and when the music stopped, collapse was swift and brutal. Foreclosures flooded the market. Banks failed. Credit froze. Contagion spread globally. The lesson from 2008 is clear. Early aggressive intervention is essential to contain contagion. But the political will and fiscal resources to mount such intervention for Florida condos remain uncertain. Without decisive action, Florida's condo crisis could follow the same trajectory. A slow-motion collapse that accelerates into panic, then systemic meltdown. Your financial shield, protecting yourself in precarious markets. So, what do? How do you protect yourself? If you own a condo in Florida or any high-risk market, get informed. Request a copy of your building's reserve study and engineering inspection reports. Know what repairs are coming and what they'll cost. If your association is underfunded or facing major assessments, start planning now. Build an emergency fund. And if the numbers don't work, consider selling before the market deteriorates further, even if it means taking a loss. Cutting losses now could save you from financial ruin later. If you're considering buying a condo, especially in Florida, proceed with extreme caution. Demand full transparency on the building's financial health, reserve funding, pending assessments, and insurance costs. Factor in worst-case scenarios. If the math doesn't work under stress, walk away. If you're an investor, this is not the time to speculate in Florida condos. The risk-reward equation is catastrophically skewed toward risk. If you already own investment condos, Assess your exposure ruthlessly. Can you afford to ride out a prolonged downturn? Are you prepared for negative cash flow for years? If not, consider exiting while you still can. For everyone, diversification is key. Don't concentrate wealth in a single asset class or geographic market. Spread risk across different property types, regions, and asset classes. And stay informed. Markets change rapidly. Data-driven intelligence gives you an edge. Knowledge is your shield in volatile times. The message is clear. Florida's condo crisis isn't a distant threat. It's an unfolding disaster with potential to spark a nationwide housing meltdown. From the shadow of Surfside to insurance Armageddon, from special assessment shockwaves to overleveraged investors, the perfect storm is here. Retirees are trapped, small businesses are suffocating, and regional banks are on the brink. The contagion pathways to other markets are wide open. This is 2008 with a Florida twist, and the warning signs are everywhere. But armed with this knowledge, you can make informed, strategic decisions. You can protect your wealth, avoid the traps, and position yourself to survive when the dust settles. Knowledge is power in a volatile market, and you now have intelligence most people don't. So if this deep dive opened your eyes, smash that like button right now. Subscribe to Housing Intel for data-driven real estate intelligence delivered every single week. Ring that bell so you never miss an update. And drop a comment below. Does Florida's condo crisis worry you? Are you buying, selling, or sitting tight? We read every comment. We'll see you in the next breakdown, because in a market this volatile, knowing where not to invest can be the smartest decision you ever make.